All right, so you're ready to start investing. That's awesome. But right away, you've probably hit this massive fork in the road, right? Do you go out and buy individual stocks, or do you go for this thing called an ETF? Look, it's one of the first and honestly most important decisions you're going to make. So in the next few minutes, we're going to break it all down so you know exactly what you're dealing with.
Let's think about it like this. It's a simple analogy, but it works perfectly. When you're putting your money out there, are you betting on one single star player to score all the points and win the game for you? Or are you betting on the entire team to win the championship together? That right there, in a nutshell, is the real difference between buying a stock and buying an ETF.
So here's how we're going to tackle this. First, we'll dive into the excitement, the thrill of picking individual stocks. Then we'll look at the power and safety of ETFs. After that, we'll compare what kind of life, what kind of effort each one requires from you. We'll even look at how they actually perform against each other. And then finally, we'll wrap it all up to help you figure out which path really makes the most sense for you. Okay, let's start with a classic move. Picking individual stocks. This is all about finding that one company, that one champion that you truly believe in and putting your money on it to succeed. The idea itself is pretty simple, right? You buy a share of a company and boom, you're a part owner. Just a tiny piece, but you're an owner. If that company soars, your investment grows with it. But, and you have to remember this part, if that one company stumbles or even fails, your investment can go right down with it. Your entire bet is tied to a single fate. And this is where it gets really interesting, because you have this incredible duality. On one hand, the upside, well, it's potentially huge. I mean, if you pick that one company that just explodes, the feeling is amazing and the returns can be absolutely massive. On the other hand, all your eggs are in that one single basket. That means the risk is super concentrated. And honestly, the volatility, the crazy ups and downs, it can be an emotional roller coaster, leading you to make some pretty stressful decisions. And this quote right here just drives that point home. It's a huge risk. I mean, think about it. Companies that used to be on top of the world, Blockbuster, Nokia, they seemed unstoppable. For every stock that becomes a massive home run, history is just littered with these giants that completely stumbled. Picking winners over and over again is incredibly hard, even for the pros. So if picking a single stock is like betting on that one champion, what's the alternative? Well, it's betting on the whole team. Let's talk about ETFs. So what is an ETF? The name sounds complicated, but the idea is simple. An ETF, or exchange-traded fund, is one single investment that holds a whole collection of different stocks. Think of it like a basket. Instead of going out and buying just one thing, you buy the whole basket at once. And just like that, you instantly own a tiny piece of every single company inside it. And yeah, it trades on an exchange, just like a regular stock. And this is a perfect example. You can buy an ETF that tracks the S&P 500. Now that's just a list of 500 of the biggest, most important companies in the US. By buying that one ETF, you instantly have a stake in all of them. You're not just betting on one company anymore, you're basically betting on the long-term success of the entire American economy. So the magic word here, the whole point, is diversification. It's just built right in. If one of those 500 companies has a terrible, horrible year, well, it's cushioned by the other 499 companies that are probably doing just fine. The risk gets spread so thin that one company failing barely even makes a dent. And you can do this for anything. There are ETFs for international stocks, for specific things like tech or healthcare, even for bonds. The whole shebang. Now this choice, it's not just about money and risk. It's also about your life. It's about your time. So the next question you really have to ask yourself is, how much time and energy do you actually want to pour into managing your investments? See, picking stocks is an active job. You got to do the research, you have to follow the quarterly reports, watch the news. You're constantly asking yourself, should I sell now? Is it time to buy more? For a lot of people, it really can feel like a second job. ETF investing, on the other hand, is fundamentally passive. It's designed for you to just buy it and hold it. You let that steady, long-term growth do all the heavy lifting for you, without you having to constantly tinker and worry. Okay, so this all leads us to the million-dollar question, right? Which one of these strategies actually does better over the long run? You know, it really is the classic story, the tortoise and the hare. The whole reason people pick individual stocks, the big dream, is to outsmart everybody else, to beat the market and get a better return than average. And that sounds amazing in theory. But what does the data actually say? So take a look at this. This part might actually shock you. This is the hard reality of it all. Over long stretches of time, the vast majority of active investors, and I'm talking about the professionals too, they fail to beat the performance of a simple, boring, low-cost market ETF. And you got to ask why.
Well, it's things like fees eating away at your returns, people trying to time the market and getting it wrong, and of course, good old human emotion getting in the way. It turns out the boring path is often the more reliable one.
And this quote just captures the entire philosophy perfectly. An ETF isn't trying to be clever. It's not trying to find some hidden gem that nobody else has discovered. Its only goal is to be the market. By just matching the performance of a huge index, it lets you harness the long-term growth of the entire economy instead of trying to bet against it.
So after all of that, what's the answer? How do you choose? How do you figure out which one of these paths is the right one for your own journey?
Well, here's the thing. There really is no single best answer that fits everybody. The right choice for you depends completely on your personality, what your financial goals are, and frankly, how much risk you can stomach without losing sleep at night.
So let's just put it all together here. Stocks, they're for the specialist, the person who loves doing the deep dive research, who enjoys the thrill of the chase, and who can handle high risk for a shot at a really high reward. ETFs, they're for the stabilizers, the long-term investor who wants built-in diversification, wants to put in low effort and is looking for steady, reliable growth over time.
And I really want to leave you with this final thought. You know, the whole financial world loves to glamorize this idea of beating the market. But as we've seen, trying to do that, well, it often just leads to mistakes. For most of us who are just trying to build wealth for the future, maybe the smarter question to ask isn't how can I beat the market, but rather do I even need to? Maybe just owning the market through a simple ETF and letting the global economy do the heavy lifting for you is the smartest path of all. Thanks for tuning in.